Well, this year so far has already given investors probably a full 2 years worth of drama just in the first 6 months. We came into the year with markets still leaning into a quite familiar playbook, shall we call it, resilient US earnings, a lot of excitement around artificial intelligence, a softer inflation path, and the hope that central banks would gradually become a lot more supportive. And then on the 27th of February, everything changed when the US started bombing Iran. And the conflict involving the US, Israel, and Iran, the disruption around the Strait of Hormuz, and the spike in oil prices turned what looked like a really straightforward risk on year into a much more complicated macro environment. And for South African investors, that obviously matters enormously. We're net oil importers, and we've seen the subsequent knock-on effect on inflation. So I think the question for investors at the halfway mark is not simply what happened, it's what has this first half taught us about risk and concentration and the importance of things like diversification, all of those things that our market sage, Wendy Myers, head of PSG Securities, likes to remind us about, but certainly came to fruition this year. Wendy, welcome. As the old market saying goes, markets climb a wall of worry, but every now and then that wall gets a little bit steeper. That's certainly where we are today. Let's just start at the top. When you look back over the first half of 2026, what's the headline for you? Was it the year that was defined by this geopolitical event, by oil, or by AI, or by the market's remarkable ability to absorb all of that bad news and just keep on moving higher?
Oh, I think, morning, Michael. I think it's all of those three, actually. I mean, these first 6 months have been really, I think it's a masterclass in showing how macro forces can pull the market into different directions. So I don't think we're seeing a single theme in delivering market returns. Obviously, the geopolitical shock from February has had a massive impact, not just around unsettling investors, but also the oil impact. We saw oil spikes up to 50%. And that obviously has massive input costs and obviously inflation impact into all the economies globally. And then there's the AI earnings. I mean, that some of these stocks have delivered incredible returns. I can name a few, actually, Micron, Samsung. So even though you've had this geopolitical friction, you've had this massive equity supply surge, and you've had companies, the Mag 7, or I think sometimes of late we're calling them the Lag 7, but they've been investing heavily in these AI in AI infrastructure. So we're seeing these AI stocks really delivering incredible returns for the markets. And then I think what's interesting for me, it's the psychology of the market. That it's been resilient this year, and it shows you that I think a lot of investors shrug off the geopolitical stuff. I think they know that often, if it had an impact, it would offer the market rebound. So the focus of the market has more been on looking at corporate earnings and deciding from there what the market level should be, as opposed to panicking because there's global risk uncertainty.
Yeah, and that really is that old phrase of markets climbing a wall of worry, but being able to look through that and to say, right, what is the scenario planning we can do? What is the likelihood of the conflict coming to an end and then returning back to the status quo? And I think, investors, to your point, came into the year expecting solid earnings, quite resilient consumers, and possibly some interest rate relief. Do you think the market was perhaps too complacent at the start of the year, or was that optimism rational until we saw that shock in the Middle East?
No, I think that optimism was definitely rational. I mean, 2025 delivered incredible returns globally. And Wall Street strategists certainly entered the 2026 year with constructive earnings expectations. Goldman Sachs projected the S&P 500 could deliver 12% this year, and that's 6% up from current levels. And the key driver is really the artificial intelligence infrastructure investment. That's accounting for half of the growth expected for 2026.
The oil shock, though, I mean, the disruption around the Strait of Hormuz turned oil into kind of the central macro variable almost overnight. For ordinary investors, why is oil not just an energy story? How does it flow through everything almost? Inflation, interest rates, company margins, consumer, and ultimately end up in equity market valuations?
Yeah, I mean, it's an input cost, like you say, Michael. So, the higher the input cost, it's not just watching the markets on a commodity story. It's understanding that the cost of oil increases transport costs. It puts pressure on margins, corporate margins. Obviously, the banks they know that there's potential that if inflation goes up, the interest rates will remain high. So that's why we're seeing this impact of oil has an impact on bond returns, on currencies, and obviously also on equities, because we factor in potential higher interest rates, and we know that that's going to deplete our expectations from an equity return perspective.
And for South Africa specifically, we know that, and we've spoken about it in the past, Wendy, the gold and platinum complex matters an awful lot because resource shares have powered the JSE to record levels early in the year. I was almost just over 100% on my Valterra position alone. That's come off significantly. Precious metals offered support, but then that support became less reliable as investor attention really shifted decisively to oil inflation. Why does an oil shock hit us differently in South Africa?
Yeah, I think so. Naturally, an oil shock hits us because we're a net importer of oil. But on the positive side, we're actually an exporter of gold and platinum. So that's why you've seen the strengthening of the rand, because our mining houses have really benefited from these higher gold and platinum prices. So yeah, I think surging commodity prices bolsters the mining revenues of the Anglos, etc. It bolsters the returns of the JSE. So we're seeing fantastic results, certainly from the financial services sector. And so you've got this kind of push-pull, of inflation going up because of the cost impact, but that's offset by the currency getting stronger because our commodity prices have run, and our mining houses are benefiting from that.
And also we had the Reserve Bank hiking the repo rate. That was an important signal, I think, really supportive for the rand as well. Is it the Reserve Bank effectively saying, and I know I've been fairly critical, that we can't control oil, but we can stop an oil shock becoming an inflation psychology problem? And what does a higher for longer rate environment mean then for the various asset classes, local equities, property, bonds, and cash?
Yeah, so I think the SARB is very deliberate around making sure that they manage the inflation target. I think the target is currently 3 to 6% that they're targeting, but I think our governor is certainly looking to a 3% target, which is pretty much what the Reserve Banks overseas, the central banks are targeting. So, what the SARB is saying is they can't control the oil impact and their shock to the economy, but they can certainly act in an inflation anchor. So meaning they can actually control the input cost to an extent by raising interest rates. Obviously, it takes away the ability for consumers to continue spending. And with those increased interest rates, obviously bank returns potentially start to improve because they've got a higher margin. But the consumer staples, those kind of stocks will take strain because the consumer spending pattern will decrease because they're having to pay more in, their home loans, etc.
Yeah, and that's where it's kind of give with the one hand and you take with the other, I guess. The JSE has had a very uneven first half. How would you characterize the JSE's performance so far? And perhaps this is where that old line applies. It's a market of stocks, not just a stock market, because underneath the surface, at a headline level, you think, well, nothing much has happened. But underneath the surface, quite a lot of rotation has happened. Are we seeing that very clearly on the JSE this year?
Oh, absolutely. I mean, we are seeing such divergent sectors. We're having we're having such a tea party when it comes to precious metals, and the prices and the returns that they delivered up until about sort of mid-May. We've certainly seen, the resource sector delivered incredible returns for gold and platinum. But June, it's come off quite materially. These stocks have pulled back from all-time highs. And remember, the biggest driver of the higher resource prices was really the geopolitical tension. And the reason these stocks have pulled back is obviously as the Middle East risk is a bit more contained. And obviously, we're also seeing reduced ETF flows into those resource stocks. Financials, I think the major banks and insurance, I think they've been quite resilient in these 6 months, Michael. I think they've enjoyed a pretty incredible run, and I see that continuing. Certainly, they've been bolstered by the stronger rand. The sector is certainly experiencing a slight pullback in June, but I'm confident that financials will deliver a solid return for 2026. I think on the retailers and consumer-facing stocks, they've faced quite a few headwinds, I see that certainly continuing, especially if interest rates are going to remain high. And listed property, as much as it's delivered healthy dividends and stable operational recoveries, we've got to consider, with high inflation and high interest rates, that potentially those returns might come off in the second half of the year. But yeah, other than that, it's been a good 6 months for those stocks.
Yeah, I mean, the listed property sector, I was facilitating the SA REIT Association biannual conference in February, and over the 2-year period to February this year, they had returned 60% in total. It's a compound annual growth of sort of 30%. Off a low base, they had been hammered after COVID as well, but it was just amazing. A lot of energy in the room saying, oh, interest rates are going to come down. We're going to be front foot and more aggressive in our deal making and capital raising. And then obviously, as we know, the 27th of February happened, and it just shows everyone can have a plan, as old Mike Tyson likes to say, until you get punched in the face. And that really was a big smack in the face. US markets, if we go offshore, initially took fright, especially growth and kind of tech shares. And you mentioned the lag 7 from the mag 7, but the recovery as well has been striking. What do you think explains that resilience in the US market?
Yeah, I think it's a mix of fundamental economic drivers and really the investor psychology that I spoke to earlier. We're seeing the sustained AI and tech spending, despite initial sell-offs over interest rate concerns and big tech valuations. I think investor confidence remains very anchored in relentless corporate expansion and capital expenditure around AI. And also, historically, the US equities, wherever they experience a brief pullback because of military conflict, like we said earlier, they always rebound very strongly. I mean, we've seen in the month of June, we've seen quite material volatility, and yet the next day, when you're expecting further downside, actually you have another rally. We saw it last night, in fact. So, really, I just think investors are aware of the big tech spend on AI infrastructure, and they're aware of the strong corporate earnings that are coming out of the US, and they want to participate in that. Yeah.
And it remains, I think, the AI trade, the big debating point in the market, and much of the engine room of the US market, as you've just said. But that volatility in semiconductors, I think it does also show how crowded and sensitive the trade has become. Do you think investors need to step back and separate the long-term AI theme from the short-term valuation risk in AI-related shares? Because as history keeps reminding us, a great company can still be a poor investment if you pay too much for it.
Yeah, absolutely. I mean, we saw massive returns from AI stocks. I think a bit of a bubble from January this year till about mid-May. And certainly it's come off quite a lot in June. I think certainly I'm a great believer in the AI story. I think that the Mag 7 will continue to invest. I think it was Samsung that came out yesterday. They are looking to invest something like $2 trillion over the next 10 years on AI infrastructure. So it got initially, quite smacked by that, because obviously the market's concerned around short-term profits. But the message to me is very clear. The companies are starting to really know that AI is the differentiator, and they want to participate in it, and they want to invest in it. So yes, there might be some spikes in the pricing, but I think if you are a long-term investor, you'll want to participate in some of those returns. I think, just talking about the Mag 7 and the Lag 7, we've seen in June a bit of sector rotation out of tech. That changed a bit last night. I see that some of the Mag 7 really did rally quite hard. I think Alphabet was up, I think almost 4%, maybe even over 4%. So I think my sense for the market this year is really, you need to be invested, but you need to make sure you focused on making sure that your sector exposure isn't too high. If you look at AI as a theme, don't have too much exposure to those stocks, but at least participate if you believe it's a long-term investment opportunity, which I personally do believe it is. Yeah.
When you see companies spending those sums on capex, it shows you that company CEOs, executives, boards are saying, we can't be left behind, because this is the future. And so it also creates interesting opportunities in the picks and shovels, as we've discussed in the past. And you see it in Micron, SK Hynix, as you say, and others that have really had a phenomenal run. And those are the companies that are supplying the chips and the RAM and all of the picks and shovels of the AI trade. I think one of the big concerns for me, though, Wendy, is this. The concentration. The US market has very narrow leadership. You've just got a handful of few mega cap tech and semiconductor stocks doing a lot of the heavy lifting. Does that worry you? And would you invest in, say, a SpaceX at 100 times revenue?
Yeah. No, I must say, I agree with you. I think it's the returns have been a bit uncomfortably narrow. If you look at Micron as a stock, I mean, that's a power stock. I think it's one of the first $1 trillion cap stocks. I was watching it last night. I think at the open, it dropped 10%. And then it actually ended last night 1% up. So massive volatility. And I think if you look at the last, the returns of the last 2 months, it's up 100%. If you look at the 6 months, I think it's up 300%. So yes, I think the returns in certain stocks are inflated, and I think certainly, if I was an investor with exposure to those stocks, I'd make sure that where it exceeds your comfort level, you take a bit of profit. On the SpaceX side, I'm going to sell on the side for a bit, Michael. I'm very uncomfortable with that share. I just can't relate to the way it makes its money. I think if you're looking for short to medium term gains, you've got to be very wary. I think it requires years of flawless execution to grow into a valuation that exceeds the combined market cap of the traditional aerospace giants. So I think if you want to take a bit of exposure, be careful and watch the market closely. Because I think it's anyone's guess where that price will be. But then I also read some articles that say you shouldn't bet against Trump. So it's anyone's guess, actually.
But I also worry when you've got a company like SpaceX about key man risk. What happens if Elon Musk were to be hit by a bus tomorrow? I'm not wishing it for, but I'm just saying there is a lot of execution that rests on one man's shoulders. And I think when any investment thesis has one point of failure like that, then it does always warrant some caution. We saw that, and to your point earlier, there was a very sharp NASDAQ sell-off on Friday, followed by a bounce on Monday as those tech and chip stocks recovered. Again, lots of volatility. What's the lesson there for investors, given this level of volatility that we're seeing?
No, I think to me, we talk about it so often, Michael. We talk about not panicking. We talk about if you want to take a bit of a profit off the table, that's fine, but don't sell your entire portfolio because you're panicking because the market's coming off. I think a classic example of volatility is early June. I think the Nasdaq it fell like over 4%, and then I think on the Monday it rallied not to the full 4%, but it was up at least over 1%. And if you'd sold, you could have locked in those losses. And then the question is, well, when do I get back in? So if you look at what's driving the market, there's so many external forces that actually don't really relate to the shares at all. The early June issue was really Iran declaring a halt to the military operations and that's what caused the rally on the Monday. So you can't foresee what's going to happen. And I think the most important thing that investors should take away from that the month of June is around making sure that your sector allocation is on point. You don't want to be too exposed to any particular sector or overexposed. And you need to adopt a long-term mindset when it comes to investing, and especially don't follow the herd. And that's where I think of SpaceX. Yeah.
Yeah, absolutely. And there's a lot of herd mentality around SpaceX. And with all due respect, we saw it in the way people were clamoring for exposure on some of the South African platforms as well. At those valuations, you just have to question that kind of decision making. I mean, one of the themes I think running through what you're saying, Wens, is managing exposure to shares that have already had a very strong run up to this point. And I think that's always tricky for an investor when you've had such a good run and you may be up 1,000%. How should investors think about trimming their winners without abandoning long-term compounders? Is there a rule of thumb around single stock exposure, for example, not allowing one share to dominate a portfolio?
Yeah, no, absolutely. I mean, we always talk around, don't have more than 5% to a single counter. And the whole purpose of that is you want to manage the volatility impact on your portfolio returns, because we know as humans, we are emotional. So if we see high volatility in our returns, that causes us to panic. So you want to do your utmost when you are designing your portfolio to make sure that, it's a robust portfolio that enjoys exposure to not just the tech sector, not just the AI infrastructure sector, but also those staples that deliver strong dividends and are well placed to cushion you should there be volatility in some of the tech stocks that you favor. So my overall guidance is obviously diversification across sectors, diversification across geographies, and limiting your exposure of counters to not more than 5% maximum.
Yeah, diversification, you've just touched on it. I think sometimes people's eyes gloss over when you talk about diversification until a shock arrives. And then you're reminded, oh, this is why I actually diversified. Do you think this has been one of the big lessons for 2026, the reminder that diversification can protect you when you can't, as you say, foresee what's going to come around the next corner?
Yeah, so it's absolutely, it's so easy to want to fall into the trap of following the herd and joining everyone else in those meme stocks. I had a fascinating discussion with the PSG advisor in May, and I was asking him specifically his view of, the rapid rise of these semiconductor stocks and these AI infrastructure stocks. And he said to me, it actually gave me pause for thought. He said, he's very happy for the market to run. It doesn't faze him. He specifically uses this time and has been in investing in high dividend paying stocks. So he's actually sitting out the AI infrastructure bubble, as it were. And he's very comfortable to do that. He said he's consistently buying up these value stocks because they're offering good multiples. And I keep thinking back to him when I see the Nasdaq experiencing these volatilities, because I know his clients aren't panicking. They're very comfortable with his portfolio returns because they are invested in those companies that deliver strong results, but not high volatility. and deliver the dividends that allows you to reinvest into the market.
Yeah, and as you've mentioned in the past, and our previous conversation was just understanding what your risk tolerance is. So if you're not going to be able to sleep well at night, knowing that the Nasdaq crashed 4% and might bounce back or might not, and what is that going to mean? There are other ways to be able to achieve your goals. The other interesting discussion, I guess, we're having in markets now at the moment is, given where interest rates have gone and the fact that the market now seems to think we might even see more rate hikes from the Fed this year, cash and I guess income assets in general are no longer irrelevant. How should investors think about cash in a portfolio right now?
So obviously, I'm very conscious of interest rates, and when you see your portfolio maybe experiencing high volatility, there's a part of you that wants to increase your exposure to cash. But I think cash is an asset class like any other, and you don't want to be too exposed to cash. Obviously, it doesn't keep up with inflation, or doesn't give you returns exceeding inflation, I should say. And you want to make sure that you see cash as, yes, an asset class that provides you with interest income, but I see it more as dry powder in my portfolio. I like having a portion of cash to reinvest in the market when I see good entry levels. That's how I perceive it. But some investors have a lower risk tolerance than I do, and they would like to probably benefit from higher interest in the coming months. So yeah, I think perhaps those investors that want to have a higher cash position, I would still say not having more than 10%. And that's because they obviously want to benefit from higher interest rates and less volatility in their portfolio.
Yeah, and there are also the tax considerations as well. Once you get above a certain return that you gain on that interest, and often look at that, and if you're reaching that, you probably have a little bit too much in cash. That's my personal rule of thumb. But everyone, is different. I know South African investors often, when they look at this and they think, well, the rand is always going to move against me when we talk about investing and offshore investing. It's not only about chasing US returns, but in 2026, I think currency exposure has again been central. We saw a weakening dollar theme that kind of reversed a little bit. But what surprised me is just how strong the rand has been. So, I mean, did that surprise you? And how should investors think about the rand in a portfolio construction perspective?
Well, our PSG economist actually says fair value of the rand to the dollar is 13. But yes, to answer your question, it has surprised me, but it's a function of our Eskom stability, to be frank, and obviously also the resource stocks rally also helped us. But if you've got an offshore portfolio, your rand returns would have been quite negatively impacted by the strong rand. But I don't see the rand dollar as a currency play. I see looking at having offshore exposure, enabling me to have access to quality companies. And the rand will do what the rand will do, and that's why it's important to have local assets and be exposed and have investments on our local exchange. But it didn't stop me from investing offshore. Yes. If my offshore portfolio in rand terms isn't looking as healthy, I think, in the days where Eskom was extremely unstable, we were seeing north of 20 to the dollar, and those investors that externalize funds there really are seeing negative rand returns. But I still believe that the importance of investing is making sure you've got exposure across geographies. So whether the rand is strong, or maybe it's a good time to take money out and invest further offshore. And where it's weak, make sure that you bring money back from your offshore portfolio. But historically, we've looked at the rand, and it has depreciated across major currencies, and that's because of South Africa's high inflation and risk premium. And this long-term trend, it may continue. I'm hoping it doesn't, that the rand remains strong and that we achieve 13 to the dollar. But from an investing perspective, you always want to make sure that you have diversification across geographies, and being exposed to these incredible companies offshore is what your focus should be, as opposed to, playing the rand dollar, as it were.
Yeah. Yeah. Listen, it's called the rattler for a reason, because it can come back and bite you at the most inopportune or unforeseen moments. And that's why, even the smartest currency traders in the world get it wrong. So the chances of us being able to time that kind of thing. But to your point, there is that structural higher inflation, which does tend to lead to a weaker currency over time. But very difficult to say. Interesting. 13 to the dollar. I'd love to see that. And also a much stronger rand euro price. After having spent a bit of time in France and Switzerland recently, you sit down for a meal for four, and 2,000 rand later, you've had a couple of sandwiches and a few waters. So it hurts. I think one of the big themes is that we've had a volatile first half. So if we look at the second half of the year now, and as we wrap up, Wendy, what do you see as the biggest danger for investors? Is it panic selling after a shock, or maybe chasing parts of the market that have already run hardest?
We've seen, I think, definitely investors panic selling. It's that fear trap, and responding to one event that causes them to sell out their market, out of the market completely, or it's other investors that chase, they experience this FOMO experience, where they want to buy into the sectors that are running, but they've already run too hard. And I've got friends that have overinvested in the resources sector, and then it's pulled back materially, destroying all their returns. And then there's those investors that sell the winning investments too early to lock in the profit, but then the share keeps running. So I think we see investors succumb to all three of these, Michael. There's no single theme. So I think that the guidance for me is to stick to your knitting, stick to your basics of diversification, and you'll be fine, and don't follow the herd.
Yeah. Why you need that process, because that process then becomes your lodestar through all of these periods of volatility. If we look ahead, what are the big risks that you're watching? I would imagine oil and geopolitics remain high on the list, but what else are you going to be watching out for in the second half of the year?
Yeah, I think certainly the Fed policy, US inflation. We've seen really strong economic data coming out of the US. But we also have seen the Fed, they're heavily constrained, right? They're seeing strong jobs reports coming out. So for them to be able to cut rates further, I think it's not looking good. I think that we're going to have a higher inflation offshore for a bit longer. And I'm closely watching the AI valuations and the market concentration on AI infrastructure stocks. It's going to be very interesting to see how that plays out, Michael. I certainly believe in the long term it's going to deliver good returns for investors, but there's going to be a lot of volatility in that space in the short term.
Yeah, and also very difficult to say who are going to be the ultimate winners there, because while there may be a net benefit, it may concentrate in the hands of a handful of players, and you don't know which ones exactly. I mean, who remembers the old Yahoo and other early .com players who are nowhere now? What's the upside? Let's invert, because I think we spend a lot of time worrying, and maybe it's a South African thing, Wendy. We like to worry, we like to whinge, we like to whine. What's the upside case for the second half?
Yeah, so I think it's a combination of energy prices coming off, inflation stabilizing because of energy prices coming off, geopolitical risk obviously stabilizing. We've seen some good traction in the last couple of days. And I certainly believe we're going to see sustained corporate earnings. I'll be very honest with you. And the central banks might surprise us with interest rate relief. I'm hoping locally, but certainly we might experience that overseas. Yeah, and I think what investors should remember is that, if there are any big market shocks, you just need to, if you look at history, realize that rebounds happen, and they typically happen quite quickly. So I think for me, the second half of the year, the theme is to stay invested. Yeah.
Well, that's where we're going to leave it. Wendy Myers, thank you very much, head of PSG Securities. Great chatting to you at the halfway mark of 2026, which has already reminded investors that shocks are inevitable, but panic really shouldn't be. So I think we should leave investors with the excellent advice of Douglas Adams here in The Hitchhiker's Guide to the Galaxy. Don't panic would be my advice for the second half. Wendy Myers, thanks so much for your time.
Great pleasure, Michael. Thank you.